Oil quotes are likely to enter another week in a positive territory. Energy prices are going up, driven by signs of a stronger demand amid improving consumption prospects in China, the world's largest oil importer. A rise in oil prices can also be attributed to the risk of reduced oil supplies in the United States, although airlines have cancelled nearly 2,000 flights due to winter storms, thus disrupting holiday travel for many Americans. Thus, the balance of supply and demand in the oil market is now particularly acute, especially with regards to oil supplies from Russia. Russian President Vladimir Putin said yesterday that he would sign a decree on retaliatory measures against the price cap on a Monday or Tuesday. Deputy Prime Minister Alexander Novak confirmed that one of such measures would include a ban on oil exports to countries that had joined the price cap. In fact, the market learned nothing new, except for an indicative timeline for the announcement of countermoves. Moreover, oil quotes even posted modest losses. By and large, the market has long priced in all sorts of rumors about Russia's response. Now it's just waiting for an official decision, so it comes as no surprise that investors have ignored the latest statements on this issue. Given that the world is at a risk of energy shortages, this should contribute to higher oil prices, and the market traditionally goes in the opposite direction from expectations. This happens quite often and could herald a fairly sharp rally in quotes. Brent crude oil futures managed to hit a new local high, coming close to the level of $84 per barrel, but shortly afterwards the volume of long positions decreased and the quote pulled back by about 3.5%. As a result, the benchmark returned to the $81 area and started to trade sideways. To resume gains, the quote needs to consolidate above the 83.5 mark on the daily chart, otherwise the asset is likely to remain range-bound. Judging by the ruble's behavior, it's now dependent solely on the political factors. As soon as Vladimir Putin unveiled the timeline for a decree on retaliatory measures against the price cap, the ruble began to gain value. Apparently, this signals a reversal and a gradual return to the mark of 60 rubles per dollar. There is a likelihood that the Russian currency will come back to this level just in time for New Year's Eve. Meanwhile, gold failed to stay firm above $1,800 per 3 ounce and dipped to nearly $1,790. Moreover, its slide coincided with the Putin statement on the inevitable retaliatory measures against the price cap on Russian energy. This means that investors are highly concerned about the possible energy shortages. It seems that they are trying to get rid of a part of the assets in order to shift to oil and gas. If gold keeps falling at the beginning of the next week and oil posts solid gains, this assumption will prove to be correct. In addition, the yellow metal is still under pressure from the further interest rate hikes that contribute to its gradual decline, so the asset's upside potential is extremely limited. To extend losses, the quote needs to fix below the level of $1,782, and in this case, gold will most likely hit towards the $1,775 mark. And that's all for now. We wish you profitable deals. See you on our channel with a new video in a couple of hours.